Okay, let's talk about taxes. Nobody wants to pay any more taxes than they have to. We have to pay taxes. The big thing about taxes here is the difference between the average tax rate and the marginal tax rate. Now this applies to you personally with regard to your income taxes, so there's lots of reasons to pay attention to this element. So taxes impact income. They're obviously important to our financial decisions. So we're going to look at taxes. Obviously there's federal, state, excise, and other taxes. They're always changing. We need to pay attention to that. The marginal versus average tax rate is very important. We're going to talk about both of those. And then financial decisions are incremental. So we always use the marginal rate. So when we think of the marginal rate, we need to be thinking about the difference between the marginal rate and the average tax rate. The marginal rate is the rate on the next dollar of earnings. It's the next taxable dollar is another way to put it. The next taxable dollar is at the marginal rate. So if you think about it, I earn whatever I earn. Say I earn $100,000 a year. The $100,001st dollar, what tax rate is that going to be? Is that going to be charged at? Well, it's going to be charged at the highest tax bracket in a progressive tax system. So let's look at an example of that. Marginal versus average. The tax rates in this chart: 15% up to 50, 25 up to 75. 34% from 75 over 75 to 100, 39 to over 100 to up to 335, and 34% over 335. Suppose your firm earns $4 million in taxable income. What is your firm's tax liability? And of course, what is the average tax rate? Well, before you do that, just let's look at the scenario I drew up. If this was the tax rate for personal taxes, and this is just made up, so the tax rate doesn't apply to anybody. But if this was for your personal taxes, and I earned $100,000 a year, and I wanted to take a side job and do something on the side, whatever it was, and earn another dollar or $5 or $10,000 or whatever I was doing. So let's say I earned another $5,000 in a side job. What tax rate would that be taxed at? Would it be taxed at your average tax rate or your marginal tax rate? Well, your marginal tax rate is all the dollars over 100,000. So here, for 34% is from 75 up to 100. Anything over 100 up to 335 is taxed at 39%. So that extra dollar, the 100,001st dollar, is not taxed at 34% anymore. It's taxed at 39%. So the way I would look at the value of doing the side job is it would be after tax after I subtracted the 39%, not my average tax rate, the 39%, because that's my marginal tax rate. Okay, if you have that, let's look at the average tax rate versus marginal in this problem. So this is basically a weighted average. The first 50,000 gets taxed at 15%. We add that to the difference between the 50 and the 75, which is the next tax bracket. That gets taxed at 25. We add that to the difference between the 100,000 and the 75,000. That gets taxed at 34. The 335 minus the 100 gets taxed at 39. And of course the 4 million, which is what the company earned, minus the 335 gets taxed at 34%. So of course we have a $1.36 million tax liability with regard to our taxes, because we have a progressive tax schedule that goes up with income. So this is much like your own personal taxes, your income taxes, your federal income taxes goes up with income. Now the average tax rate is much easier to calculate. The first thing is we just take the total tax we paid, which is $1.36 million, and we divide by the total amount of earnings that we had, which is $4 million, and we see that of the earnings we paid 34% out in taxes. So we are paying 34% out in taxes on average. And so the next question is, what's our marginal tax rate? Well, if I was considering a project that would increase the firm's taxable income by $1 million, what tax rate would I use? Well, anything over $4 million would be taxed at the 34% rate. So it would be 34% in this particular case. In the previous case, where I was talking about a salary of $100,000 in the same tax schedule, it would have been taxed at the next highest bracket because you were already at the top of that bracket. So you can see how marginal tax rates and average tax rates influence decision making. It's very important if you're pricing out a project to see how much the project will earn, that you use the marginal tax rate of the firm or of yourself. Is I'm going to do a side job, or we're going to add this project, we use the next tax bracket, or we use the next dollar's tax rate. It might be in another bracket, it might not, but we don't use the firm average. The firm average isn't relevant because we're already earning those, and we're already taking care of this lower tax brackets. We're filling those very quickly. The top tax brackets, if we push ourselves up to the top tax brackets, we may be stepping up to a higher level of taxes, or we could be, in this case, stepping down to a slightly lower level of taxes, because 39 goes back down to 34. So review this and think about that with regard to your own personal taxes, and you'll see that once in a while when you work overtime, you'll see here the bite of taxes seems to be quite large. Well, you stepped up to the marginal tax rate on top of your additional income, and therefore you're paying at a higher rate. So if you're working overtime at work somewhere and all of a sudden your tax rate seems to go up and they're taking more out of your check, it's because you're on the cusp of moving up to another tax bracket, and of course they're taking out at the higher level because it's the marginal tax rate that matters, not your average tax rate.